25-point cut that you're seeing on the Hang Seng.
TVS Motor Company is looking to, in fact, raise as much as $300 million to $350 million for its carved-out electric vehicle subsidiary.
I don't think there's very much on the supply side that can be done to bring prices down.
You could make a case that at least inflation numbers start to peak. Maybe they don't come off by a huge amount, but at least they start to peak.
So the market opens with 90 points lower.
I think 16,300 area is extremely important. If we do sustain below the same, then I might be talking about levels as low as 16,000, 16,100.
Now with this, a RuPay credit card can be linked to UPI. With an option to spend and pay later as per the billing cycle of the credit card.
Average oil price assumptions at about $118 for fiscal 23.
Well, the market's up about, 32, 33 odd points or so.
Our problem is compounded by two things. One is the oil price and the second is the FI selling.
We are seeing the pre-COVID level is already resumed. In fact, we are doing slightly better than the pre-COVID in terms of the overall footfalls in place.
The entire business case for the 5G rollout will be removed if spectrum were to be allocated.
There is no real direction that the markets are looking at today. It is sideways, but as we speak, it is flat with some positive bias.
You're entering CNBC-TV18's Fire Safe Studio, powered by Century Ply, now with firewall technology.
Well, that was a day so far. Hello and welcome to a fresh new edition of Closing Bell. I'm Prashant. With me, my colleague Mangalam Malu. Mangalam, hi. Hi. It's looking a lot better as compared to how the opening was. The last check, the Nifty was up almost about, 40 points. It's 50 now. So it's picking up pace. 16,400 plus is where the index is trading at this point in time. I mean, no obvious triggers or anything. It's really been all over the place. But just the trajectory, I mean, sharply lower start and then a gradual recovery through the course of the day, I think does bring some comfort. You want to see a day like this, not a higher start and then the market continuing to drop. You want to see maybe, not necessarily, but given a lower start, you want a gradual pickup is essentially what we've got today. I was saying this earlier in the morning, the market's been down for 4 days. That was till yesterday. It's been down straight for 4 days. And as of yesterday's close, even after the drop, the 20-day, which is the 20-day moving average, which is a near-term market sort of marker for trend, that held. So maybe it gives you chances perhaps that bounces will emerge from time to time. And I think something similar is going on right now. Just look at though one particular pocket. Metals and commodities are taking it on the chin. At least they were till the time I walked in. Maybe things are not looking as bad. But the big one, of course, is Tata Steel, which has dropped into 3 digits. It was down about 4% or so. And the Nifty Metal Index is doing pretty badly, 1.5. So it's not just steel. Tata Steel and steel is doing the worst, but Vedanta, Hindalco, others. The news seems to be out of China once again, where, there are some restrictions which are re-emerging in Shanghai. Shanghai went through a severe lockdown in the first 2 weeks of June, and then it kind of reopened slowly, but the market, of course, doesn't like it. Tata Steel specifically, Mangalam, also could be in focus because it's got a lot of operations in Europe, right? And in Europe, later today, we've got the ECB action. The graphics will come up, which I think is important. I think it's a no-brainer. A lot of analysts are saying, well, ECB is said to be very hawkish and this and that. But just look at the numbers. 8% headline inflation there, 30% producer price index inflation there. Policy rate is minus 0.5%, and the ECB is still buying bonds. So, that's why I'm saying they've got to do something. So, and by the way, even then, it's not the expectation that rates will go up. It's only that they will announce the end of QE, end of their own, what they call asset purchase program, which is nothing but QE. So, that's going to be the global news, which we will wait and watch for later in the day. The only kind of I think, positive, surprising factor will be if they are much more hawkish than what markets expect, or they're not. It's just the degrees of hawkishness which will, I think, matter to the market. Otherwise, I think it's a given that they will act later in the day. Mangalam.
Yes, absolutely. Prashant, in fact, I'm just looking at a couple of data points and it tells you the reason perhaps why the market has recovered a tad bit from yesterday's close. Yes, definitely the move from today's low has been a lot more pronounced, but we have been sitting on a 4-day declining spree. The first reason for the bounce perhaps could be the fact that, we are taking support at the technical levels. This the 20-day moving average at 16,251. The low today is 16,244. So we've bounced back from those levels. The important part, however, also is that, there were a lot of short positions. The FIs were only 27% long at the start of today's trading session, and then the macro play came by. Oil at a 13-week high, rupee at a record low. Every time the rupee is at a record low, what do you look at? You look at IT stocks, you look at pharmaceutical stocks. From yesterday itself, we had seen some sort of momentum building up in the pharma pack. So there you have it, the indices, the IT index as well as the pharmaceutical index, that's supporting the index on the one hand. And every time the oil prices rise and there are issues with regards to macro concerns, the Nifty Bank tends to underperform, and that's what took place in the last couple of trading sessions as well. So today the Nifty Bank is in the red. What else is also helping the bulls is Reliance. That has come back as well, and as we speak is at the high point of trade, gain of almost 1.5%. So that's supporting the bulls. But as we move towards the close of trade, what will be interesting is to see whether we close above that 16,400 mark or not, because it is the weekly options expiry. All the positions will expire in the next hour, and we're still seeing a fair amount of positioning added on the Nifty 16,300 put, so that looks like a strong support. But the 16,400 call is also seeing an open interest build up, so the bears haven't yet given up on the 16,400 mark yet. And were we to sustain here, there could be another round of short covering. Does that happen or not? Perhaps the reason for that would be what's going to take place in Europe ahead of the inflation data.
Oh, absolutely. I think that's a big talking point, and we'll keep an eye out on what's kind of lined up. Let's just quickly tell you what's here, by the way, over the next 60 minutes or so. So oil is, of course, one big focus area, and we'll have details on that for you. Oil stocks are doing very, very well. ICICI Lombard is, it was higher by a lot more. It's up, but off the highs, but it's outperforming the industry. There's a bit of a turn higher for ICICI Lombard in the last month. Gautam Duggad of Motilal Oswal Financial Services will join in from the sidelines of their conference with market strategy. So it's quite a packed lineup here over the next 60 minutes or so. How should you position yourself in the last hour of trade? Mitesh Thakkar of earningswaves.com is with us with exactly that. Mitesh, hi, good afternoon. Good to have you here. Your thoughts, what are trades to take? We are seeing a bit of an upturn. Would you want to go along with it or wait it out?
Good afternoon, Prashant. I think we nearly met the low side target of 16,200. We got a low of 16,243 and 16,220 is the support area. So kind of held on to that. I think it's a market which is chop around within 16,200 or 16,500. So not going aggressively long over here. But yeah, on stock specific basis, we are definitely exploring long positions given the fact that you kind of bounce back from the lower end of the range. ICICI 2 is something which comes on my radar. I think that's the stock which is breaking out, and I would say buy here with a stop at about 554 for targets of 575 to begin with. That's the 200 average area, but I think eventually the stock is showing traction and pattern of going much higher from here. IEX, the other one, that's buying with a stop at about 180 for targets of 190.
All right, we take that point. IEX is one of the stocks which has gotten a regulatory favor coming to it as well. The CERC has gone ahead and given them the nod to go ahead and roll out products which are longer than the 10-day duration that they have right now. So that would mean additional business for them. How much more? We'll perhaps have to connect with the management to get some details on that as well. But the other stock which is surging right now is Container Corp. In fact, it's been a trending day for that stock. Container Corp is up 6%. Remember, we had gotten commentary coming in from the commissioner of the dedicated freight corridor saying that 90% of the DFCC would be completed by June 2022 itself, and that would be a big positive for the likes of Container Corp or something like a Gateway Rail Freight or Gateway Distillery Parks as well. This is not new news, but the fact that there has been a reiteration of the same, it could be proving a bit of a shot in the arm for Container Corp, which anyway was underperforming up until today's trading session. We have Prakash Diwan with us now. Prakash, good afternoon. Thank you for joining in. These two stocks which are doing well this afternoon, we have Container Corp as well as IEX. Do you have any thoughts on these?
Good afternoon, Mangalam. Yes, so let me take Container Corp first. I have been very positive on this space, logistics on the whole, and particularly, the kind of assets that Concor has. It's just a matter of time before, some sort of upward movement in terms of value realization happens, maybe closer to the divestment consummation as and when it happens. But interestingly, if you compare likes to like, there's a company called Gateway Industry Park, which is much smaller from the private sector, but it has the way it has kind of shaped itself, reshaped itself, segregated two of its main businesses, and now it's available in the listed entity. Which is very comparable to the Concor asset as well. Of course, much smaller in scale. But the kind of addition to the debottlenecking that they've been doing in that entire value chain is remarkable. And you need to see the kind of work that they've done, particularly in the Maharashtra Gujarat belt. And if that were to kind of start getting scaled up as the DFC combines itself, I think it's going to be a very, very important play for the business, for the entire sector as a whole. These two companies actually straddle almost like 75% of the business at this point in time. So I'm quite positive on this space. And from a value perspective, I think Gateway District Park definitely makes a grade. It's available at almost at a valuation that is really very compelling. So that's the one. IEX, on the other hand, I mean, we've seen how consolidation has happened here. We've seen a little bit of the change today. The announcement that has kind of been fairly supportive. And this was something which was on the cards for quite some time. Because if IEX has to scale up and start drawing itself into more lucrative contracts or segments, this was required from a regulatory nod perspective, and that's happened. I'm expecting a slew of good news flow around that, Mangalam. So that's a time it will probably start doing much better. But yes, after a fairly strong consolidation post the corporate action that we saw in IEX, you'll finally see the stock start moving up, and it probably will continue for some more time. Another 15-20% of an upside would not be surprising at all.
Okay, no, absolutely. Prakash, hi, afternoon. Just coming to you, let's just visit the story on crude, of course, which is at a 13-week high. Brent is at 123, 124, and pretty much everyone is looking at higher levels. Natural gas prices, by the way, are down about 9% or so in overnight trade. But Sonal is here to put all the price action into a proper perspective. Sonal.
Thank you so much for that. Well, let me start with crude oil prices first. As you pointed out, at a 7-week high as far as Brent is concerned, NYMEX is at a 14-year high, and this is definitely coming in from increased demand that we are seeing from the US markets. As far as the Chinese economy is concerned, it has opened up, and that's why there's an additional 1 million barrels per day of demand that we are seeing from there. This is on the demand side. Supply is seeing some crunch. That is because US Cushing crude stocks have dropped to March lows. We are seeing gasoline inventories at an 8-year low in May, and that is something that has led to higher margins for gasoline globally. OPEC Plus is short by 2.6 million barrels per day as far as their targets are concerned. Additionally, US Strategic Petroleum Reserve has fallen by a record. There we are seeing gas stocks fall by 8 lakh barrels. So there is some supply crunch coming in. Demand is higher, and that's why crude oil prices, they are shooting upwards. Interestingly, there's a report by Goldman Sachs where they say that they expect average price of Brent crude at $135 per barrel in the second half, which is $10 per barrel higher than what they had anticipated earlier. This is on crude oil prices. On the gas front, yes, US prices were down 9% overnight, and that has happened because there is a fire breakout in Texas export terminal, because of which there's supply glut in the US markets, and that's why gas prices there have fallen down. However, there is an impact on the other global markets. So Asian prices are higher. European gas prices shot up 25% in trading session today. That's because they are fearing lesser supply coming through them, and that's why this fear of lower supply and higher gas prices is what we are seeing in the European region. On the back of all this, oil producers and gas producers like oil and ONGC are higher. Something like HOEC is also higher in trade, while the gas consumers or oil consumers are seeing some pressure in trade today.
All right, Sonal, thanks very much for that. Mangalam, when this entire Russia-Ukraine thing happened, and there were lots of op-eds written about how we are going to see deglobalization.
Right.
I remember when China, US, under Trump, of course, there was this big spat on Twitter daily. which used to have deglobalization was the big thing, right? If anything, I mean, it's globalization seems to have, at least for markets, become even more complex, right?
It has. And, when the interesting thing was that we had a finance professor who said when everything goes down, the only thing that goes up is correlation. So that's what's taking place.
That's absolutely correct, because the number of variables, and it's of course, I mean, financial markets were always complex, and the reaction is almost instant. The real economy, not so much. But some of these things, I think people get really they jump to conclusions too soon, I think, and we just need to wait for things to roll out and watch how it actually develops. The market, by the way, is moving on nicely. 80 points, by the way, on the Nifty. And I think one big reason why we are seeing this surge is Reliance Industries. If you can have the intraday up, it's seeing another leg higher, by the way. So, and I think this is a fresh move which we've started. The low on Reliance was made at 137 today. But this fresh leg has started from 236. It basically is 4 minutes old, this surge. And I think that explains the last 20-25 odd sort of points on the Nifty that we have. Almost 37 points of the 80 points coming in from Reliance at this stage. Prakash, I mean, your thoughts on this one? It sort of was looking a little weak, and yesterday specifically. This morning also was not looking particularly strong, but starting to fire now.
Oh, absolutely, Prashant. So, just taking cues from the conversation you and Mangala were having, when crude needs to go up or is seeming to be going up, there is going to be somebody who's going to benefit. And if crude and gas and everything is peaking out, there is no reason why Reliance will not see all that benefit accrue to its bottom line as it kind of starts scaling up in terms of growth in both these pockets. And interestingly, what's happened is there's been some positive action on the geo tariff plans as well. I mean, some of their products which are long dated or 1 year maturity, the prepaid, this thing packages, they've tweaked those prices up, and that's something which is. I'm sure it's going to help a lot of companies other than Reliance as well. But at least it's the start of a very clear indication that while you have inflation on so many other consumption pockets, telecom is not something that can remain absolutely devoid of any influence, and that's what's happening. So you will see a little bit of improvement in ARPUs going ahead, and refining is at its peak. You have gas output that is kind of scaling up. Probably Mangalam's pocket on retail is the only one that needs to kind of now start firing, and then you have a complete storm. So I think Reliance, as I said the other day, the softness in Reliance is an opportunity for people to go, and it's still under-owned. And just imagine what happens when ETF money starts coming back. As and when it happens, it could take a quarter, 2 quarters, I don't know. But as and when that happens, the allocations will be fierce in terms of wanting to buy a stock like that, which has such a significant weightage on the indices. So that's the time where Reliance will probably start seeming even more attractive to a lot of people from a technical perspective. But I think fundamentally it does offer some value even from here.
It's just about 2.5% away from its all-time high on Reliance. Prakash, I take your point on the retail business, which is expected to fire. But tell you what, in FY22 itself, which was a COVID-struck year, we saw revenues of 2 lakh crores. So that reminds me of an old saying as well, right? If you have a gun, you actually have to fire it for people to know its effectiveness. But if you have a bazooka in your bag, you don't even need to fire it. People see that and get scared. And that's exactly what Reliance Retail has been doing with the kind of acquisitions that it's been making, with the kind of scale that it has achieved. So, that is something that we will continue to monitor on Reliance itself. But I wanted your thoughts particularly on the agrochem sort of space, because we just got a notification coming in on the exchanges on UPL, and that's the reason why the stock has moved higher. They've launched a product to protect, rice yields from getting an infection of insecticides, etc., because they've launched flupyrimin, if I pronounce that correctly. And this is not just UPL centric, because earlier today we spoke to Dhanuka Agro. They've launched about 3 or 4 new molecules as well to protect the crops. Before that, we spoke with a smaller company called Best Agro. They too have about 3 or 4 new products that they've planned to launch, for which they will get around 500 crore in terms of revenue. So it seems like, a lot of these new products are being launched in the herbicide, pesticide, insecticide sort of space. With inflation in food rising, there would be a lot more focus towards crop protection. So does that make a case for you to be investing in any of these companies? If yes, which one?
Oh, absolutely, Mangalam. You hit the nail on the head. When we are so obsessively talking about food inflation, especially on a global scale, you just need to pad it up with a postulate of buying into companies that benefit with direct spends going up on protection. And crop protection is an area that will see significant ramp-ups. It's not only accessibility, but it becomes a necessity when you have very expensive standing crops. And especially, rice usually is something which hasn't attracted much of spending because of various reasons. And pesticide usage in rice is not perceived as a very positive thing in terms of value realization. But given the fact that all cereals, all wheat agri products are going to be valued much better, much more sharply, you will have to make sure that standing crops do get that protection, and which means your ability of the growers or the farmers to spend is also going to be significantly different this year. I would look at something which is far more global, which is far more diversified, and from that perspective, UPL still offers a lot of value. I mean, the other day, just a few months back, we were talking about, of course, the management denied it. There's a possibility of the management seeing some sort of a offer being made to buy a significant stake by a global player at a very significant value. And if that was any indication, of course, nothing materialized, but I'm sure there's no smoke without fire. And there was some sort of there is something afoot in terms of they trying to unlock value or seeking some sort of capital raise at a decent valuation. And if that were to happen, that also gives you a very clear upside in the making. But fundamentally, the environment is very positive. And you could look at some of the smaller companies that supply to a lot of these global majors. There's a company called Herenba. Not much of a history as yet in that sense, just a couple of years post listing, I guess. But it's been very consistent with the kind of quality of supply that it has to some of these majors, crop protection majors. But so there's enough space out there, and everybody has that space to grow. But take a Sumitomo Chemicals, take a Herenba, you could go in the value chain deeper and start identifying a lot of these things.
All right, Prakash, stay with us. We'll take a quick commercial break here. Interesting names you mentioned, so we'll check them out. The market, by the way, is pulled back even more. 85 now on the Nifty, 16,442. Reliance remains pivotal to this move, as we described earlier. We'll take another quick break here. We are back. We've got a big market voice joining us, Gautam Dugar of Motilal Oswal Financial Services, for some market talk in just a bit.
$16,450 on the Nifty and 90 points higher. What's pulling it up is Reliance, which has made another move with gusto. Prashant just pointed the move on Reliance 3 minutes ago, and 1 minute later we have a much higher move closing in on that 2,800 mark for that counter. The other stock which is actually doing extremely well is Jubilant FoodWorks. An interesting move out there, up almost 5% from lows. This morning we had a downgrade coming in on Jubilant FoodWorks from Macquarie, citing inflationary pressures on their business going ahead. But turns out for now, a large part of that could perhaps be priced in, given the sort of correction that we've seen from the highs on Jubilant FoodWorks itself. But one thing that everyone's eyeing is the weakness that we're seeing in the rupee, a fresh low of 77.8 to the dollar, as dealers took some short positions on account of the rise in crude prices. What's the way ahead? We have Lata Venkatesh explaining this move on the rupee itself. Lata.
Rupee is weakening because of the crude oil pressure. That will mean a larger current account deficit. And so it is tempting to take a short rupee position for dealers. But what we need to note is that today rupee is falling along with all Asian currencies. And surprise, surprise, it is led by what? By the yen. Not a currency you would normally expect. Now, why is the yen weakening? It's because the euro is strengthening. Euro is strengthening because this ECB meeting is expected to, finally announce an end to the bond buying and perhaps lay the ground for a rate hike this time itself or in the next meeting. This makes the BOJ or Japan the only country where there is still stimulatory monetary policies. loose monetary policies. And that is why the yen is now at a 20-year low versus the dollar and perhaps versus the euro as well. That in turn drags all the Asian currencies down. Now, on the rupee front, what one needs to know is that normally you think the rupee weakens when the dollar strengthens, but for the first time, the Indian inflation is less than the US inflation. So there is a natural bulwark against the rupee depreciating too much. Of course, at the moment, the RBI is doing a lot of dollar sales to keep the rupee from reaching 78. But the RBI is doing it with good reason. The macros are on the side of the rupee. It doesn't have to depreciate, versus the dollar. And, the dollar itself has not strengthened too much today.
Point, Lata, on that. The other couple of stocks which are moving to the high point of today's trading session, one of them is TVS Motors. TVS Motors actually moved rather well. In fact, this week itself, it's up almost 5% odd. And the other one which is making a move from the two-wheeler space is Eicher Motors. Eicher Motors too has moved to the high point of trade. And with the move today, it's actually turned positive for the week. For TVS Motor, of course, our colleague Ashwin Mohan said that they are looking to raise more funds for their EV business, and the product that they have, iQube, that has new features like Alexa, etc. as well. On the other hand, Eicher Motors, of course, having corrected a fair amount from its highs, is making a bit of an attempt. Prakash, the one is still with us. Prakash, we keep speaking to you about the auto space. In two-wheelers in particular, would you back the big old Eicher Motors, or would you go with the cute-looking iQube with Alexa and all its features?
I know. So, the iQube is something that is likely to face a lot of competition. And we've seen how fickle customer preferences could be as compared to the staid, old, lovable Eicher motor products, right? So it's actually a difficult thing. But I think what TVS is trying to do, and that's quite remarkably positive, is create a very simple niche, establish itself in that niche area with very top-grade products. They've realized that a lot of the players that are there are not mainstream. Whereas if you have the kind of capabilities that TVS has, and then they've started raising money, remember, at the right time to back things up in terms of scaling up. So that will be a very interesting play as compared to some of the other names which have probably struggled or have been very half-hearted on the electric vehicle space. So I'm quite positive on, quite excited about the TVS motor venture. Eicher, of course, Mangalam is, as I said, standard old stuff. The demand is not likely to get impacted as much as affordable two-wheelers will, which is a Bajaj CT100 or a Hero MotoCorp product or something. So from that perspective, they are far more secular, but it's all well priced. I don't think there's significant upside to make in Eicher Motors as a stock, but the company could probably be more resilient as compared to the other two-wheelers. And TVS is the one that you'll probably see some sort of spunk coming back as the EV segment starts deepening or getting well established for itself.
Okay, Prakash, thank you very much for your time. Good speaking with you, as always, here on CNBC-TV18. Well, 108 points on the Nifty, 16,464 is where we're at. Gautam Dugar is Head of Research, Institutional Equities at Motilal Oswal Financial Services. He's joining us right now from the sidelines of that conference. Gautam, great to have you with us here. Thank you very much for your time. Prashant, this side. I mean, first thoughts in terms of some feedback from the conference. What are you hearing? Is it all gloom and doom, cautiousness, worried faces, or it's all okay?
Hi, Prashant. Good afternoon. Thanks for having me. Yes, from the conference perspective, there are about 65 companies between 2 days. It's far better sentiment than what I would have imagined 2 days back, given the way the markets are behaving. Clearly, there is an interest in bottom of ideas. And fortunately, the commentary from corporates across sectors is not as bad as one would have imagined. I mean, across sectors, we are hearing very cautious but positive undertone. The undertone of the commentary is quite cautious. There is a bounce back in some of the sectors. There is pent-up demand. There is, of course, inflation, which is hurting at the margin. But it's not all gloom and doom, as you just suggested. It's far more balanced in that sense. Of course, it's not overtly buoyant and bullish either. But yes, far better than what I would have imagined a couple of days back.
Right. Gautam, I wanted your thoughts particularly on the consumer space, primarily because everyone's been talking about inflation, but there is this protracted move towards curbing inflation globally. Do you think the worst is behind companies when it comes to raw material pressures? Has it been priced in? And maybe in the second half, we'll actually see some of them posting margin expansion?
Hi, Mangalam. No, I don't think it's completely factored in yet as far as numbers are concerned, because the quarter that just went by, you saw only some impact of higher commodity prices across sectors, not just consumer. Because a lot of companies did benefit from their low-cost inventory, which was lying from before February and March. So the real impact you will see in 1Q FY23 as far as commodity price inflation is concerned. From there onwards, it will depend on how the subsequent movement in commodity prices will be. We have seen some correction, moderation in a lot of commodity prices in the last 20-30 days. But I'm afraid I don't think it will get reflected immediately in June quarter. Secondly, across the board, most of the corporates are suggesting that they are not yet confident of passing on full impact of commodity prices to the consumers because demand is not yet very buoyant. We've seen very low mid to single digit or even lower than mid single digit volume growth in most of the consumer companies that have posted their numbers in 4Q FY22. So demand is not giving you that confidence yet to pass on the full impact of commodity prices. So I think it will be a waiting game where if prices were to moderate from here on, then maybe you will not see any significant margin damage after 1Q or 2Q FY23. But yeah, I mean, it's not yet completely passed on to answer your specific question.
In terms of earnings impact, upside impact because of where oil is at and where refining margins, product cracks, etc. are for large entities like Reliance, and consequently what that may mean for, I mean, of course, if things remain and do not fall off for the full year and how that would feed into overall earnings estimates. Any thoughts, Gautam, how are you treating it? Are you treating this as a bit of a one-off? What's your sense?
So, Prashant, there are two different ways to look at it. One is the statistical impact on earnings, and second is the way market is going to value that. So if you look at Nifty as a profit pool, the composition of the Nifty profit pool benefits whenever there is an inflation, and which is what we have seen in the last 3 months. There's hardly been any earnings cut because 45 to 50% of my earnings in Nifty are well insulated or neutral to the commodity cost inflation. About 25% of my profit pool in Nifty actually benefits from higher commodity prices, which is metals and oil and gas. Of course, metals, we have seen new developments in the last 2 weeks. And then there is just 1/3 of the profit pool actually in Nifty, which gets hurt from the higher commodity prices. So when you evaluate the impact of higher commodity prices on Nifty and non-Nifty broader market, the results are going to be very different. We have seen much higher number of earnings downgrade in our coverage universe, which is X of Nifty, right? Which are domestic facing B2C companies where the pricing power is limited and the impact of input cost has been much higher. But as far as Nifty is concerned, our earnings estimates have been fairly stable because whatever damage we have seen in auto, consumer durables, staples, cement has got more than compensated by the earnings upgrade that we saw in oil and gas and metals. Now, the second part is how is the market going to look at it? Of course, the market is not going to give the same multiple that it accords to some of the stable B2C facing sectors. So we've not seen any re-rating, so to say, in oil and gas companies. You've just seen the impact of profit inflation in their market cap inflation. You've not seen multiple change, even for metal companies, if you look at the last 2 years. Whatever market cap accretion you have seen in metal companies, by and large gets explained by the debt reduction that you have seen. So the way it impacts your statistical numbers and the way market values it, these are two different things actually.
Right. There's an interesting data point that I was looking at, Gautam, and that's the difference between the earnings yield as well as the 10-year bond yield. At the start of 2021, the Nifty earnings yield was close to around 3% whereas the bond yield was, closer to that 6.5% mark. 3.5% was the Nifty earnings yield and the bond yield was 6%. So there was about a 2.5% sort of spread. And now as we speak, the bond yields have hardened to over 7.5, 7.6%, between that range. Whereas the Nifty earnings yield, basis your forward estimates, is about 4%. Do you think, for the spread to maintain, the market will have to go lower from here?
So that's classic equity valuation versus bond valuation dynamics, Mangalam. So what is happening is you are seeing a combination of adverse macro events which has resulted in higher inflation and subsequently higher yields and interest rates. What it demands basically is higher equity yields as well, which essentially means lower PE ratios. Now, it can happen through two means. Either the market stays where it is and earnings catch up with it, right? Where the market undergoes a price correction and earnings catch up with the valuation, or you see a price damage in the market and you subsequently get a PE correction. Now, if you look at the median PE or average PE of Nifty over the last 10 years or last 5 years, it is somewhere between 16.5 to 17.5. Now, right now, we're at about 18.7 to 18.8 times 1 year forward. So which way this will swing, whether you get price correction, continued price correction, or whether you get a price or whether you get a time correction, only time will tell. But there is no doubt in my mind that the two has to correct and converge, because this gap cannot sustain, gap cannot remain so wide for a long period of time. And of course, something which is a joker in the pack is the movement of earnings going forward, because last 12 months, we've not seen any earnings downgrade despite so much of headwinds, right? And in fact, for the quarter gone by also, our Nifty earnings estimates for 23 and 24 have remained stable. Whether we continue to see a very strong and resilient corporate earnings in the next 6 months, I think that is what is going to decide this specific question that you asked, wherein the movement between the gap between equity and bond yields gets determined.
Right. Just a follow up to that, which direction do you think it will move? Primarily because, we know that the RBI is not raising rates for the next couple of meetings at least.
No, I doubt, because, if you look at the real rates, they are wide into the negative territory even now. And they have raised their inflation forecast by 220 basis points from 4.5 to 6.7% in between 3 meetings, right? So the rates definitely have to move higher from here. How much higher? That will be a function of where the inflation ultimately settles down, because you're talking about a 7.5% 10-year yield and about 4.9% repo rate. That gap also is quite high. So that gap also has to narrow. Either the inflation has to fall or the rates have to go up. And if rates go up, we all know the equity valuations have to respond to that. My sense is that the corporate earnings are going to remain fairly strong. Instead of 18% growth that we are building in for FY23, maybe you get 12-13%, but you are not going back to those 7-8 years where we have seen just 4-5% earnings growth for 7 years on a trot. And then, of course, as we have seen today from the data, the AMC data which came out for the month of May, the domestic flows remain extremely strong. I think even for the month of May, the SIP book was about 12,000 crores. So I think there are a lot of counterbalancing forces which exist, corporate earnings and domestic flows, which has kept the markets very resilient, and which is where we are seeing India outperforming significantly YTD calendar year 2022 versus the EM markets. And that is partly a reflection of the flows as well as a very strong corporate earnings. And this is despite about $30 billion of FI outflows that you have seen in the last 6-7 months.
Okay, Gautam, where are you in terms of earnings estimates for FY23 and 24? Are you already at 12% over 22?
No, we are at 18%, Prashant. So we ended FY22 with a 35% EPS growth and a 40% absolute profit growth for Nifty. Our next year's estimate is 18% EPS growth, which actually works out to about 865 rupees of EPS. And FY24, while it is too far-fetched right now, given the kind of environment that we are in, but yeah, for whatever it is worth, the estimate is 1,000 rupees right now for FY24 Nifty.
All right. And finally, before we let you go, Gautam, you'll have to give us a few nuggets from your stable. What are the top 3 picks that you have from Motilal Oswal?
You mean mid-cap or overall?
Across the board. A blank check question. Top 3 picks.
Yeah, so if I go by my model portfolio, which is where we reflect our conviction and our ideas, IT remains one of our preferred picks, especially large cap, notwithstanding the kind of noises that we are hearing on the global and a macro front. So Infosys is something which we find quite attractive now after the recent 25% correction. Banking remains the most attractive large cap space in my view. The earnings have been extremely strong for the last 3-4 years, and prices have gone nowhere. So valuations are extremely attractive there. And we are seeing a pickup in credit growth. We are seeing an improvement in further improvement in asset quality. So ICICI Bank and SBI, these are the other 2 names from the financials that we like. And lastly, Titan, which has been a house favorite for the last 7-8 years in terms of consumer discretionary spend, which is seeing a fair bit of a revival. So that continues.
Okay. All right, Gautam, thank you very much. Appreciate you joining in with some of that perspective. Thanks indeed at this point in time. So that's Gautam Dugar of Motilal Oswal saying, well, they're at 865 for FY23, which means that, you know, they're on their estimates, the index valuations are about 19 times, but they say that it could drop a little bit by to about 12% or so. And that's essentially the big risk. And of course, for 24, they're at 1,000 rupees flat, which of course, I mean, could also be brought lower. How much, etc., is the question. But I think Gautam did mention, unlikely we go back to those sort of mid-single-digit kind of growth rates we had for many years before, I mean, the last few years. 16,457, the market's holding on strong. Reliance, of course, still doing his bulk of the heavy lifting. Almost at 2,800 now, Reliance Industries, with about a 2.7% gain. Welcome back. It's a good-looking screen, 121 points higher and cruising along at this point in time. Well, has the mood in dealing rooms turned around with this bounce in the market, or people are skeptical? That's essentially what we want to know. Nimesh is standing by with an insight in a segment, D Street Chatter. Nimesh, over to you.
Hi, Prashant. A very strong recovery for the markets. And again, you know, 16,400 is acting as a very strong support on the downside. What has changed today is essentially that there is a lack of aggressive selling from the FIs. That was not the case for the last many days. Today, for a change, the FI selling is much lower, is what I understand. And of course, there is the DI support as well, which is on for the last many days. And maybe that explains the move we have seen in many of the beaten down sectors and stocks today. So a bit of a relief rally in most of the stocks, on the lack of a large FI selling. What is more interesting is while there's a sharp recovery in the large cap names and the mid cap is up just 0.5%, but in terms of flows, the mid caps select mid caps are well bid by the larger FIs. So that's a contra feedback. Also, while the crude is hovering around 123, 124, today the feedback is there is a bit of contra buying into some of these crude sensitive names. So the OMCs, the paint companies, those kind of stocks are well bid. So a bit of a contra buying there. But I guess two things. One, lack of aggressive selling from the FIs, and again from a technical point of view, 16,400 acting as a very strong support.
Absolutely, Nimesh. Thanks a lot for that. In fact, as we speak, just hang in there. We are seeing a big move on the Nifty. Usually, the 3 p.m. move on the expiry, aggravates on either side. And this time, it is above that 16,400 mark, where a lot of calls were written. So, accelerated short covering taking place out there as well. What's supporting the index is that the underperformance of the Nifty Bank is recovering a tad bit. The Nifty Bank has actually recovered almost, is sitting with a gain of almost a third of 1%, which is roughly half of the Nifty's gain right now. There's the big move that we're seeing on Nifty Bank. But that's about the larger market. But Nimesh, let's get down to individual stocks. What do you have on your list?
So the first stock on my list is Macrotic Developers, Loda Developers. Quietly that stock is up 15% this month. Even in today's trade, it's buzzing a bit. And largely on back of one of the leading domestic insurance company, an active buyer in this particular stock. So even in today's trade, I believe they've been active buyers. So that's the first stock. The second stock is Dr. Lal PathLabs. Flat in trade today, but there is a very strong buzz of a large block deal soon, and the block deal could be likely, the seller could be likely, from a large private equity investor. So that's the reason why Dr. Lal PathLabs should be in focus. So that's the second stock. The third stock is Indian Hotels. Well, the stock is weak in today's trade, but there is strong buy flows at the FI desk, and I understand a leading long only fund is actively buying this particular stock, which is Indian Hotels. So that's the third stock. And the last stock is Godrej Consumers, GCPL. That stock is buzzing largely on back of buy flows at an FI desk. So the delivery volumes are going to be quite high in GCPL today, and that's the reason why it's relatively outperformed in today's market.
Okay, interesting list as always, Nimesh. Thank you very much for that. All right, the market's up 115, so no problem so far. But what trades can you take for quick reverse trades tomorrow? Mitesh Thakkar is back with us to tell us exactly that. Mitesh, hi, afternoon.
Yeah. Hi, Prashant. I think IT pack is looking the strongest in the short term, and that's where some traction could be made. My sense is that I think, buying into Wipro as a BTST trade will work out well. That's a BTST with the stop at 470 for targets around 480 for tomorrow. And the other one be a BTST on Tech Mahindra. I think that's a stock which is reversing from lower levels. So that's a BTST as well. Keep a stop at about 1129 here and target of 1155 for tomorrow.
All right, Mitesh, thanks a lot for that. Weaker rupee and some correction that we've seen in the IT pack makes it a strong candidate for a bit of a short covering bounce, so to say. And Mitesh believes that It is tradable today for a reverse trade tomorrow itself. Reliance, in the meanwhile, has actually gone ahead and crossed that 2,800 rupee mark on the share price. And with that, it's just less than 2% away from its all-time high. Let's talk about the other group of stocks, the insurance stocks. ICICI Lombard is the one which is in focus, was at a 52-week low yesterday, has seen a bit of a bounce. Yash is here with more details on the stock. Yash, take it away.
That's correct, Mangalam. So ICICI Lombard is a stock in focus. The stock at one point in today's trading session was up 4%. It's come off the high point of the day. But as you said, just yesterday, the stock hit its 52-week low, and from there has been a little bit of bounce, and there are reasons for it. The first and the most relevant trigger today would be the business numbers, the premium collection numbers, which came in for May. The numbers for ICICI Lombard in terms of premium collection have been very strong. The May premium collection for ICICI Lombard has in fact gone ahead and outperformed the industry growth. The total premium for ICICI Lombard has grown at 34% versus industry growth of just about 25%. That is one trigger. And the second one is something which happened yesterday. There was a block of about 0.75% equity or 36.82 lakh shares, which happened on ICICI Lombard. So the block is also out of the way. And right after that, there has been a trigger of the good numbers coming in for the month of May, which is helping the stock today.
Okay, ICICI Lombard, one of those big underperformers, especially is pretty stark given all of the backing and interest that it had from investors. But at about 11:25 or so, Amrish Baliga is with us for some thoughts on the market. There's 14 minutes to go for close. Amrish, any thoughts on Lombard, which Yash was just detailing?
Prashant, good afternoon. I think, like I've been saying earlier also, that I think this year should be the year for the insurance companies, both life insurance as well as general, and Lombard, in fact, falls in that. Basically because we have seen a huge amount of claims in the last 2 years because of COVID, and post that we have seen premiums also rising. At the same time, going ahead, I think the claims will be lower. So you'll have the benefit of higher premiums and lower claims over the next couple of quarters. And I think that should play off well for the insurance companies. So at these levels, I think it's a good time to pick up across.
All right. What are your thoughts on a couple of these cement stocks, Amrish? Because we have seen a fair amount of correction on them ever since Ultratech announced their capex. But over the last two trading sessions, we are seeing some bit of a bounce back. Say something like a Ramco has moved to the high point. JK Cement too has recovered a fair bit. In fact, it's now almost erased all the losses that it saw in the first three trading sessions of this week.
Like a capex by someone as large as Ultratech should not be taken negatively, but the markets took it negatively. That clearly shows that the amount of confidence which is there in the sector, the sort of a growth which can be seen in the sector over the next couple of years. At the same time, we should remember that a capex takes at least about 24 months to 30 months for that quantity to in fact come into the market. So one need not be worried that in the next couple of months you'll have the total capacity going up so much. So clearly, if you're looking at the sort of infra development which is happening, the real estate sector, the way it's growing, cement demand is surely going to increase much faster than the GDP growth which we are looking at. So, I think one should still be quite positive on cement, and this increase in capex, clearly, I would look at it positively.
Okay, we should look at it positively. Stocks, though, still, hint some glimmer of pullbacks, but not really very much there. Any thoughts on names like Tata Steel, etc., Amrish? It's seen a big 4% crack today.
Right. In fact, steel and metals overall has been a sector where I've been a bit sort of cautious to negative for the last couple of months, and I've said that the best of it is already behind. They've peaked off. So even at these levels, I would say it's time to exit the steel as well as aluminum stocks, because I think the prices have peaked out. And that's the way it's going to be, at least for the foreseeable couple of quarters. So the best is behind them. They have shown the best of profits in the last 3 quarters. I don't think going ahead, the next at least 3 to 4 quarters, you'll see what we've seen in the last 2-3 quarters.
Right, Amrish, stay on. We are seeing some moves in a couple of names. Zomato, after a big decline yesterday, is bouncing back once again. It's in fact recovered almost 6% from today's low. currently sitting around that 69 rupee per share mark. The other stock which is doing well is Avenue Supermarts as well, which has moved to the high point of trade from low in today's trading session. It's recovered almost 4.5% odd, still a fair bit away from its all-time high, almost 35-40% away. Welcome back. From the mid-cap end of things, we are seeing some bit of a recovery in a few of these stocks. Case in point, something like an India Mart that has seen a bit of a spike in just the last few minutes. Astral is the other one, which in the noon was closer to levels of almost 1637. That's moved higher to around 1684. So 50 rupee bump is what we're seeing on Astral as well, has moved into the green. And Delta Corp, that's the other one which is seeing a big rally from the lows. Remember, the stock had entered the F&O ban in yesterday's trading session, and now the futures plate does indicate that there has been some sort of open interest reduction. So the question then is that will it be out of F&O ban in today's trading session or not? And are we seeing a bit of a spike on account of that or not? We're also getting some flashes at the bottom of your screen from Bloomberg saying that China retail passenger vehicle sales in May have fallen by almost 17.5% year on year. Understandable given the sort of lockdown situations that we saw earlier too, but will that have any impact on Tata Motors or not? Because usually that's what we see. The stock is down about 1.5% in an otherwise strong day for the Nifty auto space itself. That's about Tata Motors. But earlier today, from the sidelines of the Motilal Oswal conference, we also had some commentary coming in from Ramdev Agarwal, chairman and co-founder of the company itself, to discuss everything markets. So let's hear him out.
Our problem is compounded by two things. One is the oil price, and the second is the FI selling. And FI selling is function of what's happening in other parts of the world. So I think, at the same time, we have very strong earnings growth happening. So that's how these two forces, one tailwind and 2-3 headwinds, they are pulling each other, and market is stuck in a range-bound kind of fashion. I don't think till something changes in the current setup of the risk and challenges, I think the markets will remain quite stressed, I would say. I'm surprised by the sheer number, about 3 lakh crores of the selling in last 10-12 months. That's been quite unprecedented. So they own about 20% of the market. That's about 50 lakh crores more they have. So they have enough to sell if they want to. Nothing changes, then the current pace of selling might continue. I don't have any extra information per se, but it just feels that the valuation gap is, which is the reason for which there is no other reason for FIs to sell out of India except for the valuation gap.
Except the valuation gap. Some of the thoughts coming in from Ram. The overall saying, well, things are going to be tough and through for the next many months. Earnings, of course, is his other worry, that they perhaps eventually will be earnings downgrades. And of course, the big one for India is oil, as we all know, as we've been talking about as well. Tata Communications is one stock which got completely smashed. It's jumping up a little bit, 4.5% odd. Do you track this one, Amrish, Tata Com?
No, in fact, I don't track Tata Communications closely, so it's difficult for me to give any advice on that.
No problem. I mean, let me just take a look at what else is moving. Market breadth, as I said, is positive, but not by a lot, by some 200 points. IEX is one of those, again, which sold off quite a bit. The power exchange, Amrish, any thoughts on this one?
No, in fact, I've not really been too upbeat on like IEX, although there has been some news today, but still, I would utilize any sort of upside to exit this.
Okay, use opportunities, bounces to exit this one as well. All right, I think that brings us to kind of, the wrapping stage as well as the market. Amrish, thank you very much. Great to have you with us here. Appreciate your time as always. So 130 points higher is where the market will finally close, at about 16,485. Let me just start looking at the sectors, then I'll just look at what the Nifty 50 stocks did, both on the upside and downside. So we have the oil and gas space, which once again ended higher, 2%. I mean, large thank you, of course, to Reliance. Healthcare, 1.25% higher. The energy index, largely covered in the oil and gas space, Pharma is another index which was up about 1.25%, and IT was up about 1% as well. On the downside, metals clear loser, and we had the PSU Bank space which was down about 0.25% as well. Nifty 50 stocks, that is large caps. The gainers are, of course, Reliance. There's Dr. Reddy's, BPCL 2 3/4, Aisha 2.6, SBI Life is back above 1150. Bharti was up about 2 1/4. Bajaj and ONGC, I mean, they are, at 1.5% to 2.5% kind of gains. So nothing very large. Tata Steel, of course, was the big cut, 4% down. Shree Cements, Grasim and Tata Motors are the others which lost as well. Broader markets, Mangalam.
The broader markets actually, after a couple of days, finally ended on the advancing side. So that is something that the bulls will take heart from, but not by too much, just a smidge. Roughly 2.5 stocks ending in the green for every 2 stocks that ended in the red, but a positive close nevertheless, and that is something that the street will take some heart from. Among the top gainers in the broader markets, we had Oil India, of course, benefiting from crude at a 13-week high. Container Corp on some reassurance coming in on the dedicated freight corridor as well. IEX, positive regulatory action taking place out there for them. Biocon buoyed further by the Bank of America reports. IGL, Tatacom were the other couple of stocks which ended at the high point of trade. The stocks that did not do too well, despite some long-only fund buying, Indian Hotels ended lower by almost 2% the long-only fund buying news coming in from Nimesh. Strides Pharma was the standout performer on the downside in the pharmaceutical space, which otherwise did well today. Vedanta was the other one which was down in line with all the other metal stocks as well. And AU Small Finance, of course, ended lower as it saw some bonus stripping. The stock went off its ex-bonus, so to say. In the broader markets, we also saw some gains come by in car trade technologies. In fact, higher volumes on that stock after a big fall that we've seen from its issue price. It saw some favor. Car trade was up 11%. Time Technoplast was the other one, gained by about 11% and Cera Sanitary was the other one which gained about 7% as well. Here too, on the lower end of things, we saw MedPlus, a recent IPO, down 4%. Jindal Poly was down around 4%, and Mrs. Bector's was the other one which was down 3%. So by and large, we did have more stocks advancing than declining, just by a smidge. All in all, a good day of trade.
All right. So that's the wrap today. Pretty good close, given the fact how we opened overall. Well, from all of us here, it's a goodbye. Mangalam, me, everyone on the team, thank you very much for staying with us. It's a wrap on Closing Bell, but don't go anywhere. A lot more lined up on the Thursday special. Big deal coming up in just a bit.